How's it going, everybody? Today we are going to read Naked Forex, High Probability Techniques for Trading Without Indicators by Alex Nekritin and Walter Peters, PhD. So if you are interested, sit back, relax, and get ready to learn. Obviously, we're not going to read this whole book in one sitting. We'll see how it goes, see how far we get. I'm going to read the preface first, and then we'll get right into the book. So sit back, relax, and enjoy. Let me just take this off because it might be annoying after a while. Okay. Preface. Unfortunately, most Forex traders lose out. Profitable trading is reserved for the select few. Expectations drive reality for most things in life, and successful trading is no different. These are the three myths of successful trading, and the structure of this book is based on each of these myths. Myth number 1. Successful trading must be indicator-based. The first part of this book dispels this myth. There are many ways to profit in Forex. Some of them do involve indicators, but indicators are not necessary for successful trading. There are professional traders around the globe, many of them good friends of mine, who use naked charts to make trading decisions. In some ways, indicators delay the progression of the trader because the focus is on the indicator rather than price action. Indicators become the scapegoat for losing streaks and often keep losing traders in a holding pattern. It is much easier for the novice trader to begin trading without indicators from the beginning. Myth number 2. Successful trading must be complex. The second part of this book is about naked trading systems. These systems are incredibly simple. Do not confuse simplicity with ineptitude. Although these systems are simple when applied correctly, they may also yield big profits and build confidence in your trading. You may view this as the meat of the book, the most important section, but I disagree. I think the third section is the most critical to your trading process. And myth number 3, successful trading is dependent on the trading system. This is probably the most widely held belief among traders. This is precisely why there are thousands of trading systems on the market, all promising great riches to the brave traders who pony up the money for the next holy grail. Many veteran traders understand the importance of trading psychology. Personal beliefs and attitudes toward risk are the greatest predictors of trading success. And the trading system is not nearly as important as many traders assume. For most traders, after years of trading, the fact becomes apparent. The third section of this book concerns trading psychology and how you may both identify and change your thinking, because this is the real driving factor in your trading success. Many readers will continue to hold on to these myths. In fact, some readers, those who believe trading success depends on the trading system, will simply read the second section and begin trading the naked trading systems. This is unfortunate. The first section is critical because it offers reasons for price action trading, a new belief system, and a course of action for becoming an expert at naked trading, new trading habits. The third section is where break-even and slightly profitable traders will learn to move into the realm of the true professional trader. All sections of the book are important, and it is my hope that by reading it, you will find simple methods for extracting profits from the market. You can trade successfully without indicators. For many traders, naked trading is both refreshing and easy to apply. You can trade successfully with simple trading systems. Simple systems are robust and powerful. However, ultimately, your success as a trader will depend not on the trading system, but on how you incorporate your beliefs and attitudes about risk into your trading routine. I hope this book will aid you in your journey to trading success. I also hope that you keep in touch by stopping by the companion website for this book, complete with live markets, additional tools, and new naked trading system. You will find this on the web at fxjake.com/book. All right, part 1. Naked Forex Trading Revealed. Chapter 1. The Fundamentals of Forex Trading. Welcome to the world of Forex trading. Forex is the largest market in the world. Forex traders exchange $4 trillion each day. But is Forex the best market for you? The answer depends on what you are looking for. If you want a market that never sleeps, if you want the opportunity to trade at any time of the day, if you would like to make a boatload of money in a short amount of time, Forex may be for you. It should also be noted that you may lose an incredible amount of money trading Forex in a short amount of time. Traders with very little money can begin trading Forex. In Forex, you may take relatively large trades with small amounts of money because of the favorable leverage requirements. There are many reasons to become a Forex trader, but before jumping into the reasons, perhaps we should take a closer look at the characteristics of a Forex trade. A quick lesson in currencies. Forex is simply an abbreviation for foreign exchange. All foreign exchange transactions involve two currencies. If an individual trader, a bank, a government, a corporation, or a tourist in a Hawaiian print shirt on a tropical island decides to exchange one currency for another, a Forex trade takes place. In every instance, one currency is being bought, and simultaneously another currency is being sold. Currencies must be compared to something else in order to establish value. This is why Forex trading involves two currencies. If you and I go to the beach and I tell you the tide is low right now, how do you know this is true? You may decide to compare the current water level to the pier. If there are starfish and mussels exposed on the pier, you may believe me because you can compare the current water level to the previous water level. In Forex, we compare currencies in the same way. Currencies are traded in pairs, thus, one currency is always compared to another currency. An example may be helpful to illustrate how currencies are traded. If you are a hotshot Forex trader and you believe that Euro USD is going to go up, you may decide to buy the Euro USD. Thus, you think that the Euro currency will get stronger and the US dollar will weaken. You are buying Euro USD currency pair. Another way to look at this is to say you are buying euros and simultaneously selling US dollars. The unique and often difficult to understand aspect of Forex trading to keep in mind is this. Each Forex transaction involves the buying of one currency pair and simultaneously the selling of another currency pair. If you have experience buying or selling in any market, the stock market, a futures market, an options market, the baseball card market, or the used car market, then you understand markets. For any market transaction, a buyer wants to buy something and a seller wants to get rid of something. The Forex market is simply a money market and the place where speculators exchange one currency for another. In many ways, the Forex market is no different from the stock market. The major differences between Forex and the stock market are as follows. A Forex transaction involves buying one currency pair and selling another. Also, the symbols to identify Forex pairs are consistent and systematic, unlike the symbols used to identify companies listed on a stock exchange. Forex traders buy and sell countries. It is true. Forex traders are basically buying shares in a country, just as a stock trader buys shares in a company. For example, if Forex trader Emma decides to sell the Euro USD, she is essentially selling the European Union and buying the United States. To be even more specific, we might suggest Emma is buying the economy of the United States and selling the economy of the European Union. Does this mean Emma must keep tabs on all the economic data for all the countries that she is trading? The short answer is no, but we will talk more about news and trading based on economic news and data a bit farther in this book. Just as a stock has a symbol, so do currencies. Table 1.1 illustrates the most popular currencies and their symbols. Do you notice a pattern? There is a secret code for currencies. The three-letter code for each currency pair is composed of the country, the first two letters, and the name of the currency. Which is the last letter. So, for example, the Japanese yen is JPY. The JP stands for Japan, and the Y stands for yen. The currencies listed in Table 1.1 are the major currencies. These are most widely traded currencies. And I just showed you. Players of the Forex market. The Forex market is an enormous growing market. Forex trading doubled from 2004 to 2010. And today the amount of money traded in the Forex each day is staggering. The New York Stock Exchange, the world's largest stock market, turns about $75 billion each day. Forex traders trade 5 times that amount each day. You often hear people claim that because the Forex market is so large, it is relatively easy for Forex traders to jump in and ride the trends in this gigantic market, the world's largest market. However, most Forex traders trade what is called the retail Forex market. This is a different market, akin to a parallel universe, to the real Forex market, in which $4 trillion is exchanged each day. In essence, there are 2 markets in Forex, and corporations exchange currency. In essence, there are 2 markets in Forex. There is the interbank market, where banks, hedge funds, governments, and corporations exchange currencies, and there is the retail market. Most Forex traders trade in the Forex market, an entirely different market to the real interbank market. In the real Forex market, your competition is the other Forex traders trading the retail Forex market, and believe it or not, your broker. When you make money trading Forex, these other traders in the retail market lose, and so does your broker. Most retail Forex traders do not make money. In fact, your Forex broker will assume that you are going to lose money in the long run. This is a perfectly reasonable assumption, since the large majority of Forex traders lose money. Would you like to know about the secret that Forex brokers don't want you to know? Here it is. Forex brokers divide all traders into 2 groups. There are the winners. These are the Forex traders who make money. And then there are the losers. These are the Forex traders who lose money. Guess which group all new Forex traders get put into? Retail Forex brokers believe that all new customers are unlikely to make money, so all new accounts are placed into the loser group. After several months of consistently profitable Forex trading, a trader may be placed into the winner group. It may sound surprising, but it is true. If you start making money trading Forex over several months, you will join the winners. Your retail Forex broker will begin to hedge your trades. In other words, if you are in the winner group, your retail Forex broker will take trades in the real Forex market, the interbank market, to offset the profits accumulated by the winner group. For example, if most of the traders in the winner group have decided to buy the euro US dollar, then the broker will put in a trade to buy the euro US dollar in the interbank market in hopes that if the winners are correct, the Forex broker can use the profits in the interbank market to pay the winning traders. This is how your retail Forex broker deals with winning traders. And I'm going to stop for 1 sec, take a sip of water. Okay. What about losing traders? Since most Forex traders are losing traders, your Forex broker assumes that you will not make any money when you open up an account. Only after you have consistently made money trading Forex will your broker become concerned with your trading. Guess what happens to all of those losing trades? Those losing trades fatten your broker's pocket. All losing trades are business profits for your broker. That is because your broker takes the other side of your Forex trade. Although it is true that some retail Forex brokers match up trade orders so that a trader with a buy trade order is paired up with a trader with a sell trade. However, the overwhelming majority of retail Forex brokers do not do this. Unless you are a consistently winning trader, your Forex broker will take the risk on your trades and assume that your trades will lose money in the long run. This is not something that is widely discussed, but it is true. Your Forex broker wants you to lose because your losses are your broker's profits. How would you like to make the jump from the group of losing traders to the group of winning traders? Would you like to join the 5% of winning traders? I know that you can join the 5%, and I will show you precisely how you can leap into the group of winners in later chapters. Tools of the trade: fundamental versus technical indicators. So, how do Forex traders decide when to buy or sell? There are basically 2 schools of traders, and you must decide which school fits your trading personality. The first school is fundamental analysis. Fundamental traders use economic reports and news reports as the basis for trading decisions. Forex traders who have a fundamental approach will closely examine world events, interest rate decisions, and political news. Fundamental traders are concerned with properly interpreting news, whereas the focus for the technical Forex trader is quite different. Me personally, I more am in the technical analysis category. The technical Forex trader uses technical indicators or indicators to properly interpret price movement on a chart. The Forex trader who adopts a technical indicator-based approach will examine the price charts. So, while the fundamental Forex trader is concerned with interpreting news and world events, the technical trader is concerned with interpreting price on a chart, price action. What are technical indicators? Indicators are simply another way of looking at a market price. In much the same way that it is possible to examine the speed of a car in many different ways, it is possible to examine price charts in many different ways with indicators. Just for a moment, consider how many ways you may measure the speed of a car. So, bullet points here. Measured in kilometers per hour, measured in miles per hour, measured in the time it takes to travel 1 mile, measured by the time it takes to accelerate to 60 miles per hour, measured by how quickly the car can stop. Likewise, there are many ways to look at price on a chart. There are more technical indicators than telephone call centers in India. So, what is Naked Forex? It can be very confusing for the novice trader, and this is one reason why naked trading without indicators, can be liberating. When starting out, many traders focus on the indicator. This is completely understandable, since 90% of the Forex trading books, the vast majority of Forex sites on the internet and Forex trading seminars focus on indicators and indicator-based training. Indicators encourage secondary thinking, which is a real handicap for traders looking to acquire expertise. Secondary thinking involves analyzing the indicator, spending time considering where the indicator may go rather than focusing on the market. Naked traders, by definition, focus on the market, which is very different. Focusing on indicators may be one of the primary reasons that some Forex traders do not make money. Indicators can be confusing, unhelpful, and just plain wrong. In the next chapter, we take a look at the technical trading and some of the tragic trading mistakes Forex traders make and how to avoid them by adopting the naked trading approach. Alright, so chapter 2, but first I'm going to take another sip of water. Chapter 2, Avoiding a Trading Tragedy. If you are reading this book, you are probably a technical trader. You may have spent time, money, and effort learning about indicators. You may have learned through experience that trading with indicators can be very difficult. In some ways, trading with indicators makes it difficult to find profits. Perhaps a close look at why indicator-based trading systems have difficulty finding profits in Forex is in order. All indicators are created from price data. This is what all indicators do to price data. Price data enters into an equation and is spit out as something else. Sometimes the end product is a squiggly line, sometimes a straight line, sometimes a color or a number. It depends on the indicator. The end result is always the same. The indicator changes price data via a formula. The form of this end result, the indicator, may vary, but the process is always the same. The very same indicators based on price data are meant to hint at future movements in the market. Stated in another way, an indicator will suck in price data, massage and process these data, and then spit out a graphical representation of this data. Indicators offer price data in another form. Perhaps this new form of price data is easier to interpret. Perhaps this new form of price data will hint at what the market may do in the near future. All indicator-based trading systems are founded on the idea that price data is in a better form when represented as an indicator. Trade decisions based on indicators assume that the data in indicator form is more valuable than the raw price data. And then the definition of indicator: a metric derived from price data. Historical price data, such as the open, close, high, and low, are entered into a formula to calculate the metric. This metric is then represented graphically to anticipate and interpret market movements. Traders want to know where price will go in the future. Traders pay millions upon millions of dollars for educational seminars, DVDs, website lessons, and yes, even books such as this one. The great hope for most traders is that there is a valuable indicator, or recipe of indicators, that will hint at where the market is headed in the future. Millions upon millions of dollars are spent each year by traders and also investment companies, hedge funds, banks, etc., because a slight edge may provide millions of dollars in profits. In Forex, a slight edge may even mean billions of dollars in profits. Is there a better indicator? Which indicator is best? Which suite of indicators offers a clear edge in the markets? Perhaps it is best to find out who is making money in Forex and then do what they do. Which is the magic formula? Unfortunately, the answer to this question is it depends on who you ask. This may very well be the correct answer. As we will see later in the book, trading is often relative and rarely, if ever, a one-size-fits-all endeavor. Some indicators are considered shams, others are misinterpreted by the masses, and still others are best used contrary to their original design and intent. Indicators may be incorrect. What if the indicator is correct but a bit slow to hint at the decision the market will take? The indicator might provide valuable information, but might also be slow to the party, and thus not of much value. Perhaps a slight change to the indicator formula will speed it up a bit. Perhaps indicators are similar to a wristwatch, constantly improving, more features available as needed. But would it be possible to take a wristwatch and manipulate time by running a formula through the hours, the minutes, and the seconds displayed on the wristwatch? Would the wristwatch keep better time once the formula manipulated the actual time of day? Using a formula to create a better time on a wristwatch may seem weird and counterproductive, but this is precisely what indicators may accomplish by changing and massaging price data. Indicator-based trading is taking a wristwatch and changing the time with a complex formula in the hopes that the wristwatch will somehow tell time better. Who wants a wristwatch with something other than the real time displayed? Do indicators, all of which are calculated using price data, allow us to understand price better? Perhaps it is best to put aside any philosophical differences with technical indicators. Let us assume that our indicator is based upon a magical formula, and this formula allows us to get a glimpse of the future. Our indicator magically transforms price data into some other number, color, or line, and suggests where price is headed in the near future. Unfortunately, even if our indicator is able to accomplish this, difficulties may endure with indicator-based trading. Indicators are inherently slow. The market will be moving up long before an indicator suggests it is time to buy. Likewise, an indicator will suggest it is time to sell long after the market has started falling. This is one of the main complaints with indicators. They lag behind price. This is a fair concern. Figure 2.1, I'll show you right here, contains an AUD-USD 4-hour chart with a relative strength index, or the RSI, indicator. Traditionally, there are two RSI signals. If the RSI is above the 70 level, the market is overbought. And once the RSI falls back below 70, a trade is initiated. Likewise, if the RSI falls below 30, the market is said to be oversold, and traditionally, a buy trade is signaled once the RSI moves back above 30. See arrow in figure 2.2. There's the RSI. In these examples, we see that the RSI indicator suggests a trade at about the right time. The market turned around near the RSI signal in both examples. However, the RSI did not signal a trade at the precise turning point of the market. To find these turning points, an indicator of a different type is required. One of the primary reasons why naked trading is so attractive to Forex traders is because naked trading allows for early entries into trades. Indicators may alert traders to the fact that the market has turned around after the market has turned around, but naked traders may find turning points in the market as they occur. Naked trading strategies are based on current price of market, and therefore they allow for an earlier entry. Indicator-based trade signals will lag because it takes time for price data to be processed through the formulas that make up the indicator. And then at the bottom we have the definition for indicator lag. Significant moves in the Forex market occur before a technical indicator provides a signal. We're going to stop there for now. My voice is getting tired, so make sure you hit subscribe to listen to more in the future, and check out what's down in the description down below. Also, if you're still here, if you could hit the like button, it really helps me out because I'm such a small channel. And yeah, thanks for watching. I'll see you guys again soon. Make sure you subscribe and do everything I said.